Asian stocks gained on the first trading day of December as investors cheered surprisingly strong economic data out of China. The official manufacturing PMI was at 50.2 in November versus 49.5 expected and 49.3 in the previous month. The Asian market manufacturing PMI for the month rose to 51.8 versus 51.7 in October and higher than 51.4 expected. The reports helped to ease market concerns over the state of the world's second largest economy and spurred buyers in the regional markets, while the lingering trade uncertainty capped gains eventually. As a result, China's Shanghai Composite gained just 0.13%, Hong Kong's Hang Seng Index rose 0.41%, South Korea's Kospi closed 0.19% higher, Japan's EK225 added 1.01% and was leading the gains due to a rally in clothing store chain Fast Retailing by 1.66%. Australian S&P ASX 200 gained 0.24%, and overall the MSCI Asia ex-Japan Index traded 0.23% higher. In Europe, stocks were on the rise initially, but finished sharply lower on Monday after Donald Trump wrote on Twitter that he would reinstate duties on steel and aluminum from Brazil and Argentina. In his traditional manner, the U.S. president accused both countries of devaluing their currencies and thereby hurting American farmers. The statement was painful for investors who are getting nervous about a lack of progress on the U.S.-China Phase 1 deal. And on the data front, Eurozone manufacturing activity shrank for the 10th month in a row in November. IHS Markit's final manufacturing PMI came in at 46.9. Still, the result was above October's 45.9 and higher than a preliminary estimate of 46.6. As a result, the Pan-European Stock 600 closed down by 1.6%. Germany's DAX plunged over 2%. London's FTSE lost 0.82%, while the CAC 40 in France also tumbled 2.01% on Monday. On Wall Street, the sentiment remained downbeat as major indices suffered losses as well. A series of negative news drove the Dow nearly 1% lower, while the S&P 500 fell 0.9%. The Nasdaq Composite lost 1.1%. First, the Institute for Supply Management said the manufacturing downturn in the United States unexpectedly worsened in November, with manufacturing having contracted for the fourth month in a row to 48.1, compared with consensus forecast of 49.2. Moreover, October construction spending also sharply underperformed forecasts, falling 0.8%, while a 0.4% rise was expected. Second, U.S. Commerce Secretary Wilbur Ross noted that the trade war may yet get worse before it gets better, and highlighted that Trump administration could increase tariffs on China if no agreement is reached by December 15th. And finally, investors continue to digest the reports that President Donald Trump renewed the threat of import tariffs on steel and aluminum from Brazil and Argentina. In currencies, the dollar was sharply lower across the board on a combination of dismal economic data and Trump's complaints that a stronger dollar is hurting manufacturing. Besides, the U.S. leader has repeatedly accused Fed's Powell for not cutting rates. Against this backdrop, the euro-US dollar jumped from the 1.10 support to nearly two-week highs around 1.1090 and has settled above the 100 DMA. After such a breakout, the technical picture has improved somewhat, but it has yet to be seen if the gains are sustained. To confirm a bullish break, the pair needs to stay above the mentioned moving average in the near term. As for commodities, oil prices failed to break above the $62 handle and turned negative on the day after rejection from daily highs marginally above this level. As a result, Brent finished below both the $61 figure and the 100 DMA, which is a bearish technical signal. The downside pressure persisted amid a widespread negative investor sentiment amid aggressive comments from Trump. Also, traders expressed fears ahead of the OPEC Plus meeting due later this week. Of note, the market failed to derive support from a weaker dollar and strong Chinese data, which shows that trade talks and OPEC are in focus now, with downside risks being felt from both fronts. That is all for today. Thank you so much for watching, and please click subscribe to always be in touch with the latest market news.